Hey guys, today we're going to review again the roles of money. We're going to talk about banks and we're going to talk about the role of the Federal Reserve in our economy before we kind of go on and finish up some other stuff. Here we go. All right, so we're using our frame note-taking method this time. All right, and basically at the top it says the Federal Reserve. These notes really focus on the Federal Reserve. And the Federal Reserve is about how the Federal Reserve interacts with our economy to ensure that the well-being of many Americans. And it does kind of really play that role, but it also does play a role that's very controversial because they're not a government agency. The government has no control over the Federal Reserve. It's kind of an independent agency that handles the majority of our money. In fact, if you look at our dollar bills, every single dollar bill says Federal Reserve note. Just throwing that out there. All right, so quick kind of review of the roles of money. We use the unit of exchange. We exchange for goods, products, services, etc. We use it as a standard of payment. It's good for all public-private debt. It says so right on the bill. All right, measurement of value is another thing that we see. We measure the perceived value of something, and finally we see the store of value. It can be stored for periods of time. So we're going to take a look at three types of financial institutions. These three types of financial institutions are basically every single bank that we see. First and foremost, we have our everyday bank. So maybe that's the one that you go to on a regular basis or get money from an ATM. Right? Those are known as depository banks. These are banks that we interact with all of the time. These are the banks that cash our checks. These are the banks that we use and maybe give us a debit card or a credit card. And these are the banks that basically handle the majority of our processing as individual. All right, so that's kind of what that is. That's the type of financial institution that bank is. It's a depository bank. Good example would be that Old National here in town, First Source here in town, maybe the Notre Dame Federal Credit Union, also an example of that. Next, we see a contractual bank. A contractual bank is a financial institution like an insurance company and or pension funds. So teachers in Indiana have the option of the Teacher Retirement Fund, the TRF, right? And that is a pension fund kind of put together. There is a contractual obligation of people that are using that to deposit money into said pension fund with the understanding that upon retirement, you will be paid your pension, right? Insurance companies like your automobile insurance act as a financial institution as well, so we definitely see that happening as we do that. And the last type we have is the investment type. All right, the investment type is our Wall Street banks that have large investment wings. Things like Chase, Wells Fargo, and Bank of America. All right, those would be great examples of it. Fannie Mae, Freddie Mac would be other examples, and those have been in the news a lot recently. You may see smaller wings of these Wall Street banks interacting and taking depository stuff, but overall they are the largest banks in the country, and that they usually purely deal with Wall Street. All right, that gets us to the Federal Reserve, which we want to talk about. The Federal Reserve acts as the banker's bank and the government's bank because it is the central bank of the United States. All right, it's been broken up into multiple different districts with offices and main branches in these different districts. Our closest one would be Chicago. Chicago handles the majority of Wisconsin, all of Iowa, the majority of Illinois, the majority of Indiana, and the majority of Michigan. So when you take a look at that, you can kind of see that the Federal Reserve has some kind of ways to go about and do that. It was created in 1913 with the purpose of stabilizing our economy from the swings and things that we would see during those periods of times. The Federal Reserve has a role to release money into the United States economy. They work closely with our Department of Treasury to make sure that the economy is kind of doing it. Federal Reserve really controls a lot of the economy. They make and decide things such as interest rates, how easy is it for us to get money, how much money is out in the economy, so forth, so on. And you can kind of see that happening in a lot of what we're doing. They monitor inflation, deflation, and they want to make sure that credit is available, but only during certain times. During our financial crisis from 2007 to 2010-ish, what we saw was a significant amount of credit unavailable because of all of the banks that had been issuing bad loans. Monetary policy and fiscal policy are two different things as well. Monetary policy is what the Federal Reserve really does. It focuses on using that central bank to control a country's economy and money supply. Fiscal policy, on the other hand, is our government spending. And that's what we really see. We see government spending happening with our fiscal policy. The Federal Reserve controls the monetary policy of the United States, and it does so using three main tools. The first is our open market operations, where the Fed, in my opinion, acts like a sponge. When things are getting too tight, they squeeze and let money out into the economy. When we let go and stop that squeeze, a sponge can kind of pull that money back out of the economy, much like that sponge would act with water. You squeeze, the water dumps out, you let go, and the water soaks back in. And it's really how open market operations work. The next type is fractional reserve banking, which is basically my bank only has a fraction of my deposit on hand for me to take out. And what that means is that the bank must hold a certain number, and the Fed will set this record to decide how the economy should be going. If banks are required to have a high amount of money on reserve, then that means that we are trying to slow the growth of our economy, which you're probably asking, why would we ever want to do that? That makes no sense. Why would we slow the growth of our economy? We'd slow the growth of our economy if inflation was kicking up and we're struggling with those types of things. Now, we can also lower the rate, which means that, hey, banks, you need to loan money. We need to grow the economy. We need to make it grow and expand. And that's what you would see with this fractional reserve banking happening there. Next up, we see the discount rate. The discount rate is the interest on short-term loans that banks receive to stay within their fractional reserve. All right, open market operations and fractional reserve are the two most popular tools. This discount rate is not very popular because, well, it's really all behind the scenes. How much is it going to cost me to loan money? I'm a bank. I gave out too much money yesterday. I don't have enough to meet my fractional reserve requirement tonight. I go to the discount rate window and I get a short-term loan that allows me to basically meet my reserve overnight until the next morning when I get more deposits and I'm back in it. What's the interest rate on that? And that really tells banks how risky to be in their dealings. So what? It's all important to understand this, especially the Federal Reserve and our economy, because they make up so many of our decisions for us about loans, about interest rates, about everything that goes on in our economy. The Federal Reserve has their thumb on, and it's important that we know about the Federal Reserve. All right, so hopefully this video kind of gets us started. We're going to take a look at an activity where we examine fiscal and monetary policy and how it works, and fractional reserve banking today. And then you guys are out. Have a wonderful day. Take care.